Peter, thanks for your time. Firstly, this is an extraordinary time to be delivering a result. How do you characterise the result this year?
Mike, it is an extraordinary time. The bank is dealing with the twin impacts of COVID-19 and some of our own issues, regulatory issues. And in that context, we delivered a $1.2 billion profit. It was down 2/3. $1.1 billion of that was related to our provisioning for historical issues, and then a large charge for impairments. So we had a $2.2 billion charge for credit impairments. And it's in that context we deliver the results. So it is unprecedented times for us.
And what do you see as being the main talking points, given that a number of the big impacts have already been announced? What do you think is going to be the main talking points for stakeholders today?
I think very much the outlook of the economy will be something that people want to explore. Credit provisioning, obviously, in terms of how to think about it, and capital levels given the impact on credit provisioning, and of course dividends.
Let's talk about dividends. That's likely to be something that's going to come up a bit. And given the range of options of perhaps cancelling it altogether or paying a lower one, or perhaps even a capital raising, what was the board process in coming to that decision?
Yeah, obviously dividends is an important decision every 6 months, and the board has decided to delay the decision at this point. So there won't be a dividend paid on the 20th of June. APRA gave us consistent feedback that their preference is the industry defer dividends. That was accepted by the board. The board therefore looked at the outlook, looked at the uncertainty, took account of APRA's position and decided to defer a decision at this point. We will continue to look at that through the half and give you an update at a future point.
Another bit of news, the creation of the Specialist Business Division and the strategic review of several businesses to be overseen by Jason Yetton, who is returning to the bank. Was that always a strategic goal, or is this something that has been accelerated by the COVID situation?
No, as a new CEO, one of the first things you do with the board is look at priorities, and that's what we did. We sat down and looked at the portfolio, looked at performance over the last few years, and recognised that banking has been the core of our financial performance. And so we're going to put a number of our businesses into the specialist business unit, platforms, superannuation, insurance and auto finance into that business. And I'm pleased Jason's joining us. He has some history at Westpac. He's led wealth businesses and banking businesses, and he'll conduct that strategic review. So it wasn't COVID related, it was a strategic review.
Is it an indication that Westpac might be getting out of wealth ultimately?
The way to think about it is we're looking at the businesses where we have competitive advantage and scale, and that's what's drove the decision. The wealth businesses or insurance super platforms, auto finance, are good businesses, but they don't have the scale. So we have a choice about where we're going to invest, and we've decided to focus on banking. Those businesses are good. One of the options could be they're better off to be with someone else's business to scale them up, but we'll see. That's what the strategic review will look at for us.
There's a lot of focus obviously on credit quality and impairments. There's also some more optimism about how Australia is containing the COVID-19 pandemic. What's your view? How do you see the economy over the next couple of years?
Well, first thing I'd say is the government's done a fantastic job. So we fully support all the initiatives that the government has pursued, particularly the JobKeeper initiative, $130 billion. It looks like there'll be over $300 billion of stimulus going into the economy. Again, we support that. So that is very important in helping customers and businesses navigate the period ahead. And the best thing for the bank and the economy is more customers going back into employment or back to their businesses. So that's why we fully support it. The one thing I would say on the economy is if we look at historical recessions, often it's very hard to see the way out and economies need to be restarted. So the positive side of this is there is a way to see activity speed up, and that is when social distancing is reduced. The government's in the best position to decide the speed and timing of that, and we'll be ready to support those initiatives.
Related is the market focus on the level of provisioning and the different scenarios that the bank has used to arrive at that. Can you give us an idea of what modelling was used and what the expected credit losses will be?
Yeah, so we've increased our provisioning to 5.8 billion on the balance sheet this half, and part of that was 1.6 billion for estimated COVID impacts. So what we did to do that, we updated our economic forecasts to the lower forecasts, higher employment, lower GDP. We upweighted our downside scenario in the provision, and then we put on overlays. So it was a thorough process. One of the learnings from the GFC for us is you need to use the models and judgment, and we certainly have done that, and that's what produced the 1.6 billion increase in provisioning for COVID.
Banks are obviously providing a lot of support for customers, and some big numbers in this result of what Westpac's doing. Have you seen a significant pickup in demand for loans and drawdowns of facilities in March, April, or is it mainly the loan repayment holidays?
It's different by segment. So if we look at the institutional bank, there certainly has been more large corporates coming to us to shore up their liquidity. So they might have asked for new facilities or most likely drawing down on existing facilities, so they've got liquidity around them. So that we've been able to support there. If we look at the small business market, it's been more about repayment holidays. Same in mortgages. And we think the combination of all those has been very good to help customers through this period. And where the packages don't work, we'll deal with customers individually. And so that's seen unprecedented demand on our people, and I'm very thankful to the 35,000 people that are helping us out.
There is always a lot of focus on residential housing. Do you have a feeling on what might happen based on what you're seeing in the book?
Yeah, it's very early days, but housing is about employment, and so that's the most important thing for us, to get people into jobs so that they continue to earn and they can fulfil their requirements. So mortgages is fundamentally about people having jobs. It will be a challenge. We are forecasting employment to go to 7% by the end of the year, so there will be people that we need to help through the next period. But I'd also say in housing prices, turnover's dropping, so we'll have to see where it settles, but with lower turnover, it's less of a price signal in terms of fundamental value, if you like. And I would say in the longer term, it's about population growth. So anything that we can do to grow populations and therefore grow demand for housing, that will be good as well.
Well, Peter, finally, this is your first result as CEO, and what a time to come in. Are there any further updates on strategy or ambitions that you have that you could share with us?
Well, I think the change that we've announced today about focusing on banking in Australia and New Zealand and service is pretty consistent with the past. But we are realistic that there's parts of the portfolio that we may not be able to grow as fast as what they need to grow, so that's what we put into the specialist businesses. Apart from that, we want to do service is massively important to customer base in our strategy, and that's what we'll be focused on.
All right, Peter King, thank you.
Thanks, Mike.